As shown in figure 3.1.4, we've posed the question, do resources shares behave as Rand hedges or as Rand plays? And we can clearly see, as evidence in the chart, that there's a direct correlation between the relative performance of the resources index versus the industrial index, that's in the light blue, and the Rand dollar exchange rate. And the reasons for this are quite clear. Rand weakness tends to correlate with a period of time of economic strife in the world, with a risk-off environment where emerging market currencies generally are not in demand, and this tends to correlate with a time period when demand for commodities is low, and as a result commodity prices are low. Conversely, when economic growth is strong, you tend to have strong demand for emerging market currencies, and resources prices tend to be high as well. So as a result, resources shares tend to behave as Rand plays. In other words, they benefit from or correlate with Rand strength rather than as Rand hedges. In answering the question as to whether the resources rally is sustainable, one needs to also take into account changes in forward earnings multiples, and we can see as per figure 3.1.8 that over the last quarter, despite the fact that earnings expectations have risen materially as a result of higher commodity prices, as a general rule the forward PE multiples are higher now than they were 3 months ago, and in some cases materially so. Allied to the question as to whether the resources cycle is sustainable, we need to take a view as to what's happening to supply and demand dynamics. 3.1.11 gives some indication of what's happening here, and this is the iron ore market specifically. We can see that as a result of contractions in the rate of growth of supply, which we have seen in the iron ore market, the rate of growth is starting to slow, but despite this, over the next number of years, we're still likely to have an oversupplied situation. That is, that net supply will likely exceed, in absolute terms, the demand scenario for seaborne iron ore. Figure 3.1.15 demonstrates the relative PE multiple of the Rand hedge index versus Rand plays. This is an index that we've constructed ourselves, which is a simple average in the case of the Rand hedges of Aspen, BAT, Richemont, Naspers and Mediclinic from a PE multiple perspective. And for the Rand plays, it's constructed in the same manner using the general retailers, the banks and the life assurers. And you can see here that Rand hedges have gradually been re-rating in absolute terms relative to the Rand play index, to the extent now that even if one strips out Naspers, you're now trading at a 60% premium for Rand hedges versus that of the Rand plays. Whilst we have the opinion that Rand hedges do deserve to trade at a substantial premium to their domestically focused peers, this being for reasons of them tapping into a lower cost of capital via the debt and equity markets in the global context and increasingly becoming more globalized, it is clear from figure 3.1.17 that even our grouping of chosen Rand hedges trades at a substantial premium to that of the MSCI World Index, which in itself will have a global tilt to it. It's notable that the structural re-rating has happened quite some time ago, certainly over the last 5 years, but we would also point out that the relative rating of our domestic Rand hedges versus the MSCI World is at the upper end of its historical band. Figure 3.1.18 illustrates the price to book value multiple of the bank's index going back to April 2012 versus what we would consider to be the justified price to book value multiple of the index, taking into account the cost of equity, which has a starting point as the 10-year bond yield, together with the return on equity profile of the bank's index as a whole. And as you can see, banks have tended to have looked quite expensive on this basis for some time. The gap has narrowed somewhat, but we would argue that due to the fact that the cost of equity is substantially higher than it is today versus the average over the last few years, the gap is still somewhat wide, and that the justified price to book value multiple is a bit lower than where it is trading now. We do concede, however, that the index is quite bifurcated, with an exceptionally highly rated First Rand, together with arguably Standard Bank, compared with commensurately much lower multiples being paid for Nedbank and Barclays Group Africa. Figure 3.1.19 demonstrates that there is a direct relationship between the return on equity for the banks and the price to book value multiples paid for these banks. And this follows logic in the sense that if one pays a given PE multiple for a bank, As the return on equity profile rises, this would tend to result in a higher price to book value multiple, given that it's this book value and the return thereon that determines the earnings being generated by the business.